We're jumping straight into energy fuels today. Everyone is watching the price action, but the real story is how they are quietly becoming the bottleneck for America's critical mineral independence. I mean, we're seeing a stock that has absolutely been on a tear. We're talking about a move of, what, roughly 180% year-to-date here in early 2026, hitting 12-year highs. The chart, it just looks like a rocket ship, quite frankly. But if you look under the hood, the fundamentals, specifically regarding the White Mesa Mill, are shifting this company from just a mining play into a strategic infrastructure play.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
And before we get into the nuts and bolts of this move, make sure you subscribe and hit the like button. We are here to simplify the complex and help you spot the trends before the crowd does, so lock that in. Okay, so let's start with the obvious. When I see a stock chart go vertical, up nearly 200% in a couple of months, my first instinct is usually hype. Is there actually meat on the bone here? Or is this just, retail traders getting excited about a ticker? Because the numbers out of Q3 2025 were loud, but are they sustainable?
They were loud, and to answer your question, there is definitely meat on the bone here. This isn't a meme stock situation where the price is just totally disconnected from reality. You mentioned the Q3 revenue hitting $17.7 million. That's a 337% jump year over year.
Which is a massive number,
Yeah.
sure. But let's be honest, we're coming off a pretty low base, right?
Yeah.
17 million isn't exactly Apple money.
We are, but the context here really matters. For a long time, Energy Fuels was essentially in, hibernation mode. They were just keeping the lights on, waiting for uranium prices to recover, and that recovery has arrived. So that revenue jump isn't some one-time accounting trick or an asset sale. It is driven by volume. They are physically moving significantly higher volumes of uranium. They totally crushed their 2025 guidance.
So they promised the market, we're going to dig up X amount, and they delivered X plus.
Wow. What?
Significantly more. They just blew past the numbers. And if you zoom out to the trailing 12 months, revenue is nearly $79 million. That's effectively doubling from the previous period. They've gone from surviving to thriving very, very quickly.
Okay, so they're selling more rocks. That's good. But selling rocks is a tough business. Margins are usually razor thin. You're at the mercy of commodity prices. Why is the market treating this like it's the next big tech breakout?
Because they aren't just selling rocks. They own the toll road.
Yeah.
We have to talk about the White Mesa Mill in Utah, the crown jewel. I see this in every single analyst report I read.
Well, White Mesa.
White Mesa. What makes this mill so special? Isn't a mill just a factory where you crush rocks?
Well, yes, but try building one today. The regulatory hurdles alone would take you a decade. The White Mesa Mill is the only operational conventional uranium mill in the United States.
The only one.
The
Entire country. How is that even possible? We have the largest nuclear fleet in the world. We have reactors everywhere.
We do, but for decades we offshored the dirty work, or we used a different method. Most uranium mining in the U.S. shifted to a method called ISR in situ recovery. Think of ISR like sucking a milkshake through a straw. You inject chemicals into the ground, you dissolve the uranium, and then you pump up a solution. It's cheaper, it's cleaner, but you can only do it with very specific types of soft geology.
Okay, so that's the milkshake method.
Right. But if you have hard rock or actual rocks you dig out of the ground, you can't use a straw. You need a conventional mill to crush it, grind it, leach it with acid. And White Mesa is the only place in the U.S. that can do that.
So let me get this straight. If I'm a mining company and I find a massive deposit of high-grade uranium rock in Arizona, I can dig it up, but I can't do anything with it unless I send it to Energy Fuels.
Basically, yes. Or you ship it overseas, which is a logistical nightmare and, frankly, a national security risk these days. Energy Fuels has a monopoly on processing conventional ore in the U.S. That is a massive strategic moat. It acts as a shield against competitors, even big ones like Cameco. Cameco's a giant. They're the blue chip. But even they don't have this specific asset inside U.S. borders.
That explains the infrastructure play angle. They control the choke point. If you want to play in that hard rock sandbox, you have to pay the toll at White Mesa. But you mentioned grade earlier. I want to circle back to that because there's a lot of buzz around this Pinyon Plain mine.
Right. Pinyon Plain is the secret weapon for their margins right now. In mining, grade is king. It basically means how much actual uranium is in a ton of rock you dig up. Most of the world's uranium is effectively low grade. You have to process tons and tons of dirt just to get a single pound of yellowcake.
Which costs a ton of money. You're paying for fuel, labor, sulfuric acid, all to process what is essentially waste rock.
Exactly. Pinyon Plain is the highest grade uranium mine in the United States and likely one of the highest in the world outside of, say, the Athabasca Basin in Canada. We are talking about ore that is just incredibly rich.
And they're processing that right now.
Yes, late 2025 and into this early 2026 period, that ore is feeding the mill. The expectation is that this run will produce over 1 million pounds of uranium. And because the grade is so high, their cost per pound just drops through the floor.
So it acts as a margin fixer.
It's like high-octane fuel for their earnings engine. They've been dealing with inflation just like everyone else. Chemicals cost more, labor costs more. But when your rock is this good, it hides a lot of sins. It allows them to be profitable on that production, even if costs are rising somewhere else.
Okay, so we have a uranium bull case, price is up, volume is up, and they have the best rock and the only mill. That's a solid business. But that doesn't explain a 180% stock move in 2 months. There has to be something else driving this frenzy.
There is. And this is where the story pivots from, say, mining 1.0 to critical materials 2.0. It's the rare earth elements, or RE, expansion.
This is the phase 2 expansion I've been reading about.
Correct. Energy Fuels is betting the farm that they can become a major producer of neodymium praseodymium.
NdPr. I always stumble over that. Let's just call it NdPr.
Let's stick to NdPr. These are the magnetic rare earths. If you want a high-performance electric vehicle motor, you need this. If you want wind turbine offshore, you need this. And crucially, if you want the guidance system on a Tomahawk missile to work, or the actuators on an F-35 fighter jet, you absolutely need NdPr.
And right now, who controls that market?
China. Almost entirely. They control the mining, but more importantly, they control all the processing.
So the U.S. government is panicking.
Panicking might be a bit strong, but they are certainly highly motivated. The Department of Energy and the DoD are desperate for a domestic supply chain. But here's the problem. Rare earth processing is nasty. It's chemically complex, it's radioactive, it's expensive, and usually Western companies go bankrupt trying to do it because they just can't compete with China's subsidized costs.
That was going to be my next question. We've seen other companies try this. MP Materials, Linus, it is not a walk in the park. Why does Energy Fuels think they can actually do it?
Because of the White Mesa Mill again. The chemistry needed to process uranium is actually somewhat similar to what you need for rare earths. They already have the permits to handle radioactive waste, which is the biggest hurdle for any new entrants. And they released a study showing they can produce NdPr at an all-in cost of roughly $29 per kilogram.
Is that good?
It's exceptionally good. It makes them cost competitive globally, not just good for a U.S. company. It means they don't necessarily need a permanent massive subsidy to survive. They can actually compete on the open market.
So the bull case is basically vertical integration. They dig the holes, they own the mill, and now they're pivoting into the most critical materials for the next 20 years of tech and defense.
That's it. That is why the stock is a rocket ship. They are positioning themselves as the alternative to China for the entire U.S. supply chain.
Okay. I'm feeling the FOMO. It sounds perfect.
It does sound perfect.
Which makes me nervous because in my experience, when a story sounds this perfect and the stock is up this much, usually the easy money has already been made. So let's pump the brakes, kick off the rose-colored glasses. What's the flip side?
The flip side is simple. You are paying a Lamborghini price for a company that is technically still driving a Honda Civic.
Meaning the valuation is way ahead of the reality.
Way ahead. Let's look at the price-to-sales ratio. This is a classic metric. How much are you paying for every dollar of revenue they bring in? Right now, Energy Fuels is trading at over 40 times sales.
40 times.
40.
Put that in context for me. What does a normal mining company trade at?
A standard boring miner might trade at 2, 3, maybe 4 times sales. High-growth tech stocks, the NVIDIAs of the world, they trade at 30 or 40 times. So the market is effectively valuing Energy Fuels like it's a software company with infinite margins.
That is rich. That is what we call priced for perfection.
Exactly. When you are priced at 40 times sales, you cannot slip up. You cannot have a delay. You cannot have a cost overrun. The market is saying, we believe you will execute on everything perfectly, forever. If they miss an earnings beat or a project gets delayed by 6 months, the air can come out of that balloon incredibly fast. The cushion is gone.
And despite that revenue triple up we talked about, are they actually making money?
No, that's the reality check. Net income is still negative $97 million. Earnings per share is negative 46 cents.
They're burning almost $100 million a year.
roughly. Now, to be fair, that is good burn. They're spending money to build factories and expand mines. It's investment, but it's still cash out the door. You can only burn cash for so long before you have to raise more money.
Which means dilution, issuing more shares.
And crushing the stock price. And speaking of burning cash, let's talk about the cost of this rare earth ambition. That Phase 2 circuit at the mill, the thing that justifies the infrastructure thesis. The CapEx estimate, the price tag to build it, is $410 million.
Almost $500 million.
For a company that isn't profitable yet.
And that's the estimate. I've never seen a large industrial project come in under budget.
Never. Especially not with complex chemical processing facilities. If that $410 million turns into $600 million, or if the timeline slips a year, that stock price is going to get hammered. They are effectively betting the entire company on this expansion working.
There's also the macro risk, right? I saw that in Q3, their costs surged nearly 600% year over year.
Yeah. That was partly due to ramping up production, but it's also just inflation. Chemicals, steel, labor, it's all more expensive. And remember, they're selling commodities. If the price of uranium softens.
Or if China decides to flood the market with cheap rare earths again.
Which they've done before, specifically to bankrupt Western competitors. If rare earth prices crash, that $29 per kilogram cost advantage might not look so good anymore.
That is the commodity trap.
Oh.
You can be the best operator in the world, but if the market price for your product drops, you're toast. So we have a massive moat and huge growth potential, but we are paying a nosebleed valuation and taking on some serious execution risk.
High risk, high reward. It's the definition of a momentum play.
So for the listener who is holding this stock or maybe thinking about buying the dip, what are the triggers? We need to be tactical here. What are we watching in the next, say, 30 days?
Get your calendar out, February 25, 2026.
Earnings date.
This is the big one. We need to see two things. One, is the uranium ramp-up continuing? Are they actually selling what they said they would? And two, we need clarity on that high-grade ore from Pinyon Plain. Is it actually improving the margins on the bottom line?
We need to see the cash burn slow down.
Significantly. And we need an update on that $400 million CapEx number. If they come out and say, hey, inflation is tough, it's actually going to cost $500 million, that's a sell signal for a lot of people.
Okay. What about the government? We talked about the DOE wanting this domestic supply chain.
This is the wild card. The Department of Energy has a $2.7 billion pot of money for uranium enrichment and critical minerals.
That's a lot of grant money.
It is. Energy Fuels is perfectly positioned to grab a slice of that. If you see a press release pop up saying Energy Fuels awarded $100 million DOE grant or a low-interest government loan, that changes the math completely.
It de-risks the CapEx.
It validates the entire thesis. It says the U.S. government considers them too big to fail. If the government is paying for the factory, the shareholders win.
There's also some chatter about M&A mergers and acquisitions.
There is. In the January 21 call transcripts, they dropped some hints about downstream opportunities.
What does that mean in plain English?
It means they might buy a company that makes the magnets, not just the powder. Or, more likely, they sign a massive offtake agreement.
A contract.
A long-term contract. Watch for a headline like, General Motors signs 5-year deal with Energy Fuels, or Raytheon commits to buying NDPR. If they lock in a buyer, the revenue becomes predictable. The market loves predictable revenue.
That moves it from a science project to a real business.
Precisely. That would be the proof of concept for the rare earth division. Moving from we can do this to we are selling this.
Okay, let's bring it all home. Give me the lowdown.
The lowdown is this. Energy Fuels is a company in transition. They are trying to butterfly from a simple miner into a critical infrastructure hub for the U.S. energy grid and defense sector. They have the assets. The mill is unique. The mine is high grade.
Right.
But the price you are paying for that story is steep. At 40 times sales with negative income, you are walking a tightrope. You're betting that management executes perfectly and that the U.S. government steps in to support them.
It's a bet on the American industrial renaissance.
It is. You're paying for 2030's potential with 2026's dollars.
Here is a final thought for you to mull over. We always like to leave you with something to chew on.
Think about this. We've been obsessing over the valuation. Is it a miner or is it a tech stock? But maybe that's the wrong comparison. Mining companies trade at low multiples because it's a cyclical, dirty business. But defense contractors, the Lockheeds, the Raytheons, they trade at premiums because they have steady, government-backed contracts that last for decades.
Security clearance is a moat.
Exactly. With the geopolitical world getting more fractured and the U.S. desperate to secure domestic supply chains for defense and technology, does Energy Fuels stop being valued as a mining company and start being valued as a defense contractor?
That is a fascinating shift. If the market re-rates them as a partner to the Pentagon rather than just a company digging holes in Utah, that 40 times multiple might look cheap in 5 years.
It changes the whole equation. It's a question of identity. Are they selling rocks or are they selling national security?
Feeling national security. That puts a whole different spin on the ticker. It certainly does.
All right, that's the lowdown on Energy Fuels. High stakes, high speed, and right at the center of the energy transition.
It's going to be a wild month for them. Keep an eye on that February 25th date.
Will do. And hey, if you got value out of this, if we helped you see the board a little clearer, do us a favor. Subscribe to the show. It helps us keep the lights on and keeps you in the loop.
And hit that like button. It helps us simplify the complex for more listeners just like you.
We'll catch you on the next one. Stay curious.
And trade smart.